Hello. In our last two lessons on money, we learned that money is mainly in the form of deposits. And deposits are in the banking system. And these deposits are actually electronic bookkeeping entries. So, what I'd like to do in this particular video is I'd like to show you some of the bank accounting around money creation and how money is actually represented on the books of a bank. Okay? We need to understand that if we're going to get into what we call monetary policy a little bit later in Unit 3. So, money is an asset. It's something of value that the holder of money owns. But from the bank's perspective, deposits are a liability. So let's go down through, make sure that you're taking notes here. And it's really, really wise to jot these things down because, again, we have to get them off the video or off the ebook into us. And one way we do that is by writing things out and thinking about them, actually putting our touch to the concept. So again, most money, let's just go through this again. Most money is in the form of deposits. Deposits are where? Deposits are in the banking system. They show up in the banking system as bookkeeping entries. Money is an asset to the owner of money. So whoever the owner of the deposit is, that's an asset to them, something of value that they hold. But here's a new concept. Deposits are a liability to the bank. Now let's just take a second and think about this before we actually write it out. If you put $1,000 into a bank, you are still the owner of that $1,000. And from the bank's perspective, the bank legally owes that to you. They're holding it, but it is not their legal possession. So from the bank's perspective, a deposit is a liability. It's something that's owed to the depositor. Very important concept. Now, if we take a look at the basic accounting equation, if you take an accounting class, maybe you've taken an accounting class, the very first formula you see in that entire class, it's usually on the first page of the book. I used to teach accounting in my former life. When I graduated from Michigan way back in, 1979. Where were you in 79? And I was doing a little part-time teaching at the community college, thinking of going to graduate school or going to law school. I wasn't sure at the time. I did teach a little bit of accounting part-time at a community college called Kellogg Community College, which is my hometown. My father worked for 40 years at the Kellogg Company, worked as a factory worker at the Kellogg Company, which makes ready-to-eat cereal and still does. Okay, anyway, back to our regular programming here. If you go back to the first page of the accounting book, sorry for the digression, you'll see this equation, assets equal liabilities plus owner's equity. So let me give you an example here, a personal example, not a business example. Say that you now own a car, an automobile, that is worth $10,000. And say this $10,000 is its market value. You know it's the market value because somebody has offered you $10,000 to buy it from you. You only need one buyer and one seller to make a market. So if you're selling your car and you put a price of $10,000 on it, and there's one buyer out there who will pay you $10,000 for it, that's the market value. Okay? And suppose that you borrowed to actually buy that car and you still owe $2,000 on it. So it has a market value of $10,000, but you still owe the bank, you owe somebody, whoever you finance, the financing company with the automobile company, you still owe them $2,000. We could say then that you have $8,000 of owner's equity. In other words, your interest in the car is $8,000. The credit card company or the loan company or the financier, the one that helped you finance the vehicle, you still owe them $2,000. So they have a $2,000 interest in the $10,000 car. And obviously, when you liquidate the car, you convert it, you sell it, and you convert the asset from a car into money. You're not going to get to keep all 10,000. You're going to have to pay off this note, this liability of $2,000. So assets, same thing for businesses. That's some personal finance. But from the standpoint of the business sector, assets equal liabilities plus owner's equity. Businesses have assets that they use to carry out their business. They borrow sometimes to finance their assets. And then most owners have put something into their business. They have their own equity into the business. And hopefully as the business grows, the business will accumulate more equity as they leave some of the profits in the business, and the business gets larger and its market value gets larger. Okay? Now you say to yourself, what does this have to do with banking, and what does it have to do with money? I'm going to show you it has everything to do with this. So let's go to what we call a T account. And a T account is nothing more than a picture of the balance sheet of a bank. And this is Bank Z. And Bank Z is in the business of taking deposits and making loans. And that, in fact, is how Bank Z basically stays in business. It takes deposits. It may pay a little bit of interest on those deposits. It turns around and it makes loans. And it earns more interest on the loans than it pays on its deposits. That difference is called the spread. And from that spread, the bank can pay its expenses and it can actually maybe earn a profit. If it's a nonprofit financial institution like a credit union, you don't call it a profit, but it still is a profit. It's a surplus, but it's still a profit. Excuse me. So here we have Bank Z, and this is a balance sheet. Now, you see that I have the assets, the liabilities. I have not put the owner's equity on here. So really what a balance sheet shows, it's an accounting of a business's assets, liabilities, and owner's equity at a point in time. Okay? So say that somebody comes along, and I'm going to use the same numbers that I've used in your textbook here, your e-workbook. By the way, this is in topic 6 of unit 2. So I'm going over concepts still in topic 6 of unit 2, and this is the 3rd video. So there's a lot of important concepts. Let me say it again. I'm advertising. Make sure that you take a look at topic 6 of unit 2 in your e-workbook. I will tell you though, after watching these videos, it will be a little bit easier to navigate through that material, which is both economics and accounting, and it's bank accounting, which is, even if you've taken accounting, you may not have studied bank accounting. All right, so let's say that someone comes along, a person named Jones, last name is Jones, and Jones puts $1,000 into Bank Z. From Bank Z's perspective, and we're looking at this from Bank Z's perspective right now, those deposits are a liability. In other words, on Bank Z's books, Bank Z owes the $1,000 back to who? Back to Jones. So Jones has an account with Bank Z, and that $1,000 sits on the liability side from the bank's perspective. From Jones's perspective, if we looked at Jones's balance sheet, the $1,000 is on the asset side, but we're not looking at Jones's balance sheet. We're looking at Bank Z's balance sheet. Now, that deposit is going to put an asset in Bank Z's possession. Bank Z not only owes that $1,000 to Jones, but now has a $1,000 asset called reserves. I'm having a little trouble here writing today. I'll try to do a little better job. There we go. And so these reserves, and we'll assume this is the United States, so US dollars, these reserves are on the left side under the asset side. So on the balance sheet, you normally will put the assets on the left side and the liabilities and owner's equity on the right side. So assets equal liabilities plus owner's equity, as I showed you above. Now, This is not where the story ends. This is where the story begins. But nevertheless, this is an important part of the story. So I'm just going to put a dotted line across here. This is one transaction. I'll call this transaction A. So I'm going to put a little a up here, lowercase a. That's transaction A. Jones makes a deposit into Bank Z. But Bank Z is not in the business of simply holding Jones's money. Bank Z is in the business of taking those funds and loaning them out and earning a higher interest rate on those funds than what it pays Jones for leaving them there. Now, Jones may not leave them there long. Again, as I've said, the more the deposits are like money, say we're talking demand deposits and saving deposits, the more likely those funds are going to come in and then go back out. But if you look at a bank on average, it always has deposits on hand, even though people are putting funds in and pulling funds out, and it always has reserves on hand. Okay, so on average, a bank carries a certain level of deposits every day, and those deposits show up on the left side as assets, as reserves. Okay, now, what has Bank Z got an incentive to do? It's got an incentive to loan these funds out. So depository institutions fundamentally are in the business of taking deposits and then which create reserves and then turning around and loaning most of those funds out to generate interest income from which it can pay its bills and earn a profit. Okay, so say that somebody comes along. By the way, these are the same T accounts that I actually have in the book again. So I'm looking off to the side here to make sure that I'm using the same. I mean, I could make the example up again, but a new example, but I'm just wanting to use the same T accounts. So in looking at this, you've already, in a sense, you're doing some reading already. This is going to help you break some ground with your reading. So say that there's a person who comes along, Smith, who wants to take out a loan. Okay? Now, from the bank's perspective, a loan is an asset. It's a promissory note. It's a promise to the borrower is going to repay the bank. So from the bank's perspective, a loan is an asset. So say that this person, Smith, comes along. This is transaction B. And Smith comes in and signs a promissory note, which is a promise to repay. And on that promissory note, there will be the amount of the loan, let's say $800, the interest rate that's going to be charged, let's say 5%. So this loan is going to be a 5% interest rate, have a 5% interest rate on it. And this loan has to be, let's say, repaid in a year. Okay, so there's 12 months, maybe 12 payments that have to be made or whatever. Okay, so the loan shows up on the balance sheet as an asset to Bank Z. Smith has signed his or her name to this loan and is on the hook legally to repay this money. When that loan is signed, the bank is going to put $800 into Smith's account. So Smith, normally banks are not going to loan to someone who is not already a bank customer. So if you walk into a bank and you're not a customer of that bank, and the bank decides they're going to loan to you, even though you're not a customer, you're going to have to become a customer. You're going to have to probably open up an account. They're going to do some sort of credit analysis of you. They'll do a credit check. And they're going to actually determine whether they really want you as a customer and want to loan money to you. So anyway, Smith has an account with this bank. And now Smith's account goes up by $800. He just borrowed, let's say Smith is a he just borrowed $800. So from the bank's perspective, the bank now has this asset called a loan and this liability, which is owed to Smith, of $800. Now what's interesting, and I'm just going to note it right now, we'll be talking more about it later, that this bank has just created money. You go, what do you mean? Smith signs a piece of paper, a promissory note, and gets a deposit. Look at this, gets a deposit. Does Smith believe this is really $800? And the answer is yes. Why? Because it is. It is $800. Smith can take these funds out and spend them. In fact, why did Smith borrow? Smith borrowed from Bank Z, and maybe you could indirectly say borrowed from Jones, because Smith wanted to go out and buy something with this $800. And if this isn't a big enough number for a loan, put a zero on it and make it 8,000 and think about a car. So, whatever Smith borrowed this for, maybe go out and buy furniture or whatever Smith is thinking, Smith now has $800 in his account and he isn't going to sit on it. What's he going to do? He's going to take it out. So he's going to withdraw it. In other words, he's going to withdraw it and he's going to spend it. He didn't borrow it to sit on it. That would be dumb. You go, why? Well, why would he borrow and pay 5% interest on a loan and then leave it in his account and only earn, let's say, 2% interest on it? That would be dumb. So Smith might be paying, he might be paying 5% on this loan. Why would he leave the funds in over here and only earn 2% on it? He'd be losing 3% on that money. So he didn't borrow it to earn interest on it. He borrowed it to spend it. That's money. Deposits are money. And look, this brings up a very important it's really a macroeconomic secret. Most people don't know this, that everyone thinks that government creates all the money. And to some extent, government does create some money. But at the end of the day, banks also create money. If deposits are money, Bank Z just created deposits, which means they just created money. Okay? Now, to make the balance sheet balance, we have to recognize that when Smith pulls the $800 out, reserves go down by $800 over here as well. Notice the balance sheet stays balanced, plus 1,000, plus 800, minus 800, plus 1,000, plus 800, minus 800. So the balance sheet balances. It has to balance because it's an equality. Assets must equal liabilities plus owner's equity. So let's go ahead and move down a little bit farther, and I'm going to clean this up and show you what the net result is after that transaction has taken place, after those two transactions have taken place. So notice two transactions here. Transaction A, let me just write this. Transaction A is basically the deposit. That's Jones. And then transaction B is the loan, which has to do with Smith, right? Okay, two transactions. Notice every transaction affects the books at least two ways. This is called double entry accounting. In fact, transaction B actually affected the books four ways. Well, this is really two transactions here. I mean, it's not only Smith getting the loan, but it's Smith taking the proceeds out of the bank. So it's the loan, he borrowed to take the funds and go buy something. So we're going to put that under one transaction. But that one transaction, look at this, has four basic effects on the balance sheet of Bank Z. Now, again, let's go back down, and we're going to wrap this particular video up. I'll show you, kind of make the point that Bank Z operates in what we call a partial, or some books and some instructors, some professors call it fractional reserve system. What do you mean, a partial or fractional reserve system? Well, after that loan is made, if you take those two transactions up there and consolidate it, what do you have left? You have Bank Z sitting here with $200 in reserves. Still $1,000 deposit over here. Who is this? This was Jones, wasn't it? Who did the deposit? Yeah, Jones. So there's $200 in reserves against $1,000 in deposits. This is a mess. Let me try this again. Mr. Sipsik's having technical difficulties here. So this is $1,000 deposit, and this deposit is credited to Smith. So the bank has $200 in reserves, and it has an $800 loan that Jones is signed to. So notice that this T account still balances, but notice that here's the big point that I'm trying to make is this bank only has $200 in reserves against this $1,000 in deposits. And this is how banking works. This is how banking works. Banks can't be profitable. There's no reason for them to exist if they don't take most of their reserves and loan them out. Now, some banks either make loans or they actually invest the funds, say in government bonds or other types of relatively safe assets. But the fundamental business of a depository institution is to take deposits and make loans. Okay, that's why banks and credit unions and institutions, other depository institutions exist. That's it. So if banks are going to make a profit and exist, they have to operate on what we call a partial or fractional reserve basis, which means there's never enough reserves in the banking system to cover all of the deposits. You go, well, that's unsafe. That's crazy. Well, it's not. Most people want to leave their money where? In banks. So most money is kept where most of the time? In banks. It's only if people panic and all of a sudden want to pull their funds out of a bank will banks fail. So it's during times of panic or uncertainty, major economic crisis or political crisis or military crisis, that you'll hear of people running on their banks. In other words, depositors going to their banks and trying to pull all their funds out of the banking system. Why do people leave their funds in the banking system? Because the bank is a relatively safe and effective, efficient way to handle your monetary business. It's much easier to keep your money in the form of deposits that you access with a debit card than to be holding all this paper at home. You know, if your house burns down, you lose your money. If the bank burns down, not likely, but if something were to happen catastrophically to the bank building, it still has electronic records. It still has records, backup, it has backup systems, and it still has records of who's deposited, how much they've deposited, etc. Okay, so it's much safer for people and much more convenient for people to hold their money in the form of deposits in the banking system, unless there is a panic, a bank panic that happened during the Great Depression, 1929, 1930, 1931, right in there. That depression lasted from 29 to 1933, and there were over 10,000 banks failed during that Great Depression. And back then, there were not all of the protections we have today. Many of those deposits were not covered by deposit insurance. So many people lost their life savings or lost all of their money when these banks failed. Because take a look here. If this bank fails, if Jones doesn't repay his loan, then Bank Z, if you have bad economic conditions and Jones can't repay his loan because he's been laid off or fired or he's died, then Bank Z will never recover that loan and will be in great difficulty to repay this deposit to Smith. So if there's widespread non-payment of loans going on because of some major economic catastrophe, these loans aren't going to get repaid, or there's going to be a large number of these loans that are not going to get repaid. And Smith is going to try to go and get his deposits out as fast as possible, convert them to cash, but the bank is going to be hard pressed to do that when it doesn't have enough reserves to cover that. So this is what happens when banks fail. If people panic and pull all their funds out of a particular bank, that bank is likely going to go down. If they lose confidence not just in one bank but in the entire banking system, then the entire banking system can melt down, because this is a partial or fractional reserve system. Okay, now this isn't where the story ends. Okay, I'm going to wrap this video up because I think we've covered enough in this video. But what you're going to learn in the next video is that this can work in reverse, that just as banks create money when they make loans, the repayment of loans actually destroys money. Or maybe that's too strong of a word, actually deletes money out of the banking system. So let's get this in our head. Well, maybe I can write this down below here. Is when a bank makes a loan from its reserves, it creates deposits. Say it creates a deposit, and a deposit is money. Now, in the next video, I'll prove to you that when the loan is repaid, that deposit is basically deleted or negated, or if you want to use strong language, destroyed. Okay, we'll wrap up here. This is video 3 in this series. There will be a video 4. And I'm going to get to working on that, getting that ready for you. But once you've got this information digested, you'll be ready for the next video. Okay, take care.